Welcome back, everybody, to another episode of Acquisitions Anonymous. I'm Mil Snell, one of your hosts, joined by Michael Girdley and usually Bill D'Alessandro. Acquisitions Anonymous is the number one podcast on the internet for small business M&A, and we're kind of giggling in the background because if you're on YouTube and watching this, not just the audio, you get to see some amazing swag that Michael Girdley has on today.
It's my Halloween costume. I'm a Chili's employee.
It's Chili's hat, Chili's shirt, and even Chili's socks.
Yeah, I got Chili's socks.
So good times today. We're having fun, and we're joined by a really, really cool guest. I've been really excited about Michael Yarmo joining us. Michael is with Newpoint Advisors, and he does turnaround work, which I feel like is the kind of redheaded stepchild of the SMB community because we don't know what we don't know, and that seems really scary. So he's going to come demystify it a little bit today. Michael, really glad you're here, man.
Oh, thanks. And Mike is making me hungry with the chili swag. I think I'm gonna have to make a stopover after this podcast is done.
Yarmo gets guests of the week. That's what this is about. Way to go, Yarmo.
Well, Michael, give us a little intro on you, kind of a 1-minute snippet on who you are and kind of what brings you into your current line of work.
Yeah, I've been formally in the turnaround restructuring, distressed PE sector for about 5 years now, working out of as a managing partner with a Chicago-based turnaround restructuring firm called Newpoint Advisors. I personally do a lot of capital advisory work where we're either completely taking over the companies from a capital stack and management point of view, or kind of riding alongside current management to get them out of whatever funk they're in out of. It might be a capital input or just straight up us working on a fixed fee basis. But we do dozens and dozens of kind of small to medium sized turnarounds, anywhere from $100 million down to probably about $5 million in top line, or about $20 million in senior debt or less. So kind of that sweet spot in the middle. Anything smaller than that is probably too small of a nut for us to crack and can't get turned around quickly enough. Anything larger than that, there's other firms out there who have already established a much stronger niche. So we feel like that this space is really kind of a sweet spot for us. I got into this industry actually through running my own frozen food logistics company. So I had done that for 5 years prior to that. A couple of partners and I found a struggling Italian bakery distribution company who had several trucks and many points of distribution, but owners had been running the company for many years and really had not put a lot of effort into the company. Kind of came into the office. Yep, the lights are still on. Yep, here's my check, and thank you. I'll see you in 2 weeks from now. And in a very super competitive business like food distribution, just can't you can't be in a situation where you're half-assing it. So we came in, brought some new ideas, did a lot of channel strategy and tech upgrades, and really kind of brought some fresh eyes in the business. Ran it. I was personally running it in the president role for several years, and then we ended up selling it after a successful exit.
That's so cool. Well, I have a million questions, but we're going to hold that thought. Michael has a word from one of our sponsors, and then you've brought some really cool deals that I can't wait to talk about and be able to delve into.
Yeah, super cool. Well, the best guests are the ones that bring deals. So thank you, Michael. Makes us better hosts. Mm-hmm. But yeah, so for our listeners, we're on a never-ending quest to have this podcast break even, and we have 2 sponsors this week that are helping with that. So we'll talk about one now and one later. But the first one is our first Mills renewal sponsor who's come back because their sponsoring has been so successful of the podcast, and that's tinyacquisitions.com. I will pull up their website for those of you that are online. If you're looking to buy a small business or a tiny business, that's what tinyacquisitions.com does. So those folks have been with us for a while. They're less than 10K, smaller type projects. And it's typically somebody that has, built something, maybe got a few customers, but never really had it go beyond that. So techies are selling businesses on that and stuff like that. And you are typically a buyer, like a marketing specialist or somebody that's good at hustling and making a business grow. They have thousands of online businesses that sell for less than $5,000. And there's a click button to buy those products and start cash flowing immediately. So a great thing if you're looking for a side hustle, especially in the digital space. Thank you to tinyacquisitions.com, because they're a great place for our listeners to consider that if you're wanting to kind of dip your toe in the water to do acquisitions. So over to you, Mills.
Awesome. Thanks. Well, I'm gonna kick it back to Michael for the first deal here, and we'll delve into some more kind of nuanced questions once you get into this, Michael. But just briefly before you start, I want to make sure that I'm framing this correctly. And this may be an oversimplification. A company can be distressed in one of two ways, right? Its balance sheet can be underwater, or its income statement could be underwater, right?
Yeah, those are generally speaking, yeah, those are the two ways. Balance sheet means they're unable to make their loan payments. It all flows back to you being unable to satisfy your creditor claims. The source of that could be a balance sheet reason. You took on too much debt and you couldn't grow your way out of it, which we see all the time. Or you have lousy business operations and your cash flow ends up being negative. It's either a COVID impact or bad management or a change in your industry, and that relates to you have a reasonable amount of debt on your balance sheet, but your income statement just doesn't generate enough cash for you to satisfy your creditors. And all of a sudden, the bank or the IRS or pick your creditor channel comes knocking on your door saying, "Hey, you didn't pay up," and they're going to take some type of action, whether they're secured or unsecured.
Yep. All right. Cool. Well, give us the first deal.
So, first deal, it was a interesting case. It was a company called Peeled Snacks, and oftentimes we do tend to keep the deals generalized in terms of the name, but this one actually hit the Wall Street Journal, so I'm able to talk about this one a little more freely. This is a company based out of Rhode Island, had a really nice line of products, all in the CPG industry. Dried fruits and a bunch of other kind of snacking products sold through, the Targets and the Walmarts of the world and the Amazons. Really good e-commerce business, but also airports, hotels, schools. And all of a sudden, when COVID comes around and kids are staying home, people are not traveling, airports and hotels are closed down. All of a sudden, 50% of your revenue is gone. And that was the kind of the start of starting to uncover what was happening with this company. When we were approached by the not only the senior creditor on the file, but also the PE company that had been owning it, we also discovered that the margins were frankly just terrible. They were one of the first companies into the organic space many years ago, but never priced themselves like an organic business. So, if you go to a grocery store and you go to Whole Foods, they have that term whole paycheck. Well, there's a reason for that, right? A lot of their goods are organic, good for you. Well, these guys had priced themselves like a regular brand, but had to incur the cost of an organic grower. And those lousy margins combined with the huge cost of trying to build up a brand led to negative cash year after year after year. But they're well-to-do owners driven by this PE company had funded the losses every single year. And all of a sudden, when COVID comes in and wipes out whatever growth had been going on, they took a step back and said, "I don't want to fund the losses anymore." And all of a sudden, the secured lender on the file puts up their hands and says, "I'm not liking what I see here. I'm not getting my principal and interest payments back on all the money I've forwarded to you guys." And all of a sudden, it shows up on our radar. So that's often how the deal flow works: is we're either getting a call directly from senior creditors or from insolvency attorneys who have all of a sudden been pulled onto the file to say, "Hey, this company's in trouble. They're going to need some type of legal work." And insolvency attorneys, for all their skills, are not turnaround professionals, and they're not necessarily business people. They need somebody to come in and actually take a look at, how do I fix my balance sheet? How do I fix my income statement? And it's either one of the two, or more often the case, both. So we enter the file, and again, doing more research on the company, we ended up finding fraud on the file, where The kind of the management before us had lied on some loan documentation, and a business that was just way overspending for its size. It wasn't even close. It wasn't even like spending for growth and hoping that the investors would kind of pick up the tab. They were just spending way outside of what any reasonable startup, and they weren't even really a startup. They were a 20-year-old company, or were really willing to do. So we came in and said, okay, we think we can fix a lot of this. However,
Michael, real fast, how did you know that spending was out of line? When you first took a look at the deal.
Yeah, I have a CPG background myself, either coming through my own food companies or earlier in my career I'd worked in big CPG and big corporate firms, and I kind of knew right off the bat when you're spending 70% of your revenue on marketing. That's probably not a good metric. I think anybody, with half a brain can probably see that pretty quickly. But if you're spending 70% year after year after year on brand building, and it's not relating to more brand awareness, that's a case where it's probably a good time to relook at that and have that flow back into improving the balance sheet and getting your senior creditors paid down.
This was owned by private equity with some pretty smart investors. How did they let that keep happening?
Great question. I think it was a case where everybody thought this brand would be a lot bigger than it was going to, and it was growing at a decent clip, but not a tech clip, especially when you're spending 70% of your revenue on marketing. It was never growing quickly enough, and they were constantly trying to rejig the strategy to find new ways to get it growing quicker. So it was
Michael,
always
quantify for us. I'm sorry to interrupt you. Quantify for us, what was their revenue kind of top tick when things were still growing and sales were happening on all channels? What did it decline to, and kind of how did that decline actually manifest itself? Was it immediate in one quarter, or kind of gradually over time? And then from a net income basis, what was happening cash flow wise in the business?
Yeah, it got up to 25 million, in the good old days of 2019, and then dropped quite quickly to about 10 to 12 million after all the So it was that's probably what gave the ownership pause to say I can't fund this anymore. It dropped from a slightly break even company to a $2.5 million loss pretty quickly. It was really, we all know what how COVID impacted the world. It was really a quick night cut to the for them that over one quarter the bank takes a look at their files and says, oh my God, what happened to this company? It was Q3 started rolling into the banks. It was pretty obvious that this company was in serious trouble.
And what like relative level, you don't have to talk specifics if you can't, but what's kind of a ballpark amount of, debt that they had outstanding as this was happening?
Yeah, it was about $7 million in total debt. So just below where we needed to, to file a subchapter 5 filing, because that's about $7.5 million and above. So they were just kind of under that threshold that gave us pause to say, hey, you know what, we can actually fix this balance sheet through the court systems. That would be probably the best, most efficient way, and we can actually get them through pretty quickly with a subchapter 5 filing.
So what does that mean? And you can talk to me like I'm 5 years old, because I don't totally follow. So just educate me here.
Yeah, absolutely. So, probably everybody is familiar with the terms Chapter 11 or Chapter 7. Chapter 7 is you're just straight up liquidating the assets, and whatever's left over at the end of the day, you're distributing back to likely the creditors, maybe most likely not. The ownership will get crumbs, but you're really just you're trying to give pennies on the dollar to your creditors. 11 is a more of a restructuring clause where you're trying to stay as a going concern coming out of bankruptcy. The creditors are going to have to take a haircut, but the ownership often gives up control of the business and basically hands it back to the creditors. And it's not a great situation for for the ownership of the company going through an 11. It helps the creditors out and tries to get them as much as they can in terms of their initial investment, but it's not a great situation for everybody. Chapter 5 is actually a bit different. So it's a code under number 11. It's a newer filing. It was something that was passed by Congress in early 2020, and it gives small businesses the chance to get through the court systems quickly, efficiently, with as minimal cost, to either having to hire somebody like me, an insolvency attorney, auctioneers, somebody like a Gordon Brothers, as low cost as possible, but ownership retains control. So ownership comes out the other side, and they still have control over the company. So that's the nuanced difference between an 11 and a subchapter 5.
So typically in that process, the borrower, like you're saying, they retain control, and are they getting, a reduction of principal that's owed on the outstanding debt? Or are they getting, some kind of, deferred payment schedule? Or are they getting, do the terms of the loan change as well as the total outstanding amount?
Yeah, and I get a lot of questions about this in terms of how do I use subchapter 5 to my benefit when I'm buying a business, and it's often a case where you can come in one of two ways. You can either snag the company up before they file, go in with a little bit of hopium into the courts, diving into the court systems, and basically present a plan to a judge to say, this is what I'm going to do from not only a cash flow perspective. Here's the costs I'm going to cut. Here are the tactics I'm going to change to improve the profitability of the company, and hope that the judge says, yeah, I like this. We'll move you through, and we'll establish a payout plan to your creditors. So you as an owner get to retain control, but your creditors are going to have to take, some type of payment plan, and they can't deviate off that. They're no longer able to kind of go back and try to clean their assets again. It's a bit of a Hail Mary, and it's not something I particularly want to do as an investor, but it is an investment strategy. It's a bit of a Hail Mary. The other way you could do it is which is a little safer, which something I've taken a look at, is you can come in as a DIP lender, so a debtor in possession lender, with some type of conversion to say, hey, I will come in. The company is already filed. It's already in the court systems. I will come in with some type of debt structure called DIP lending, but I'm going to apply a conversion while in the court systems. That if we can get out of this mess and get the company back on a cash flow perspective, something along the restructuring line triggers you to actually become a part of ownership. Mm-hmm. So big Hail Mary pre-filing. After filing, you've got a little bit more protection, but you're still coming in and trying to turn around a broken company with a debt plan.
All right, that's cool. That's a helpful survey. All right, so going back to Peeled, they're burning about $2.5 million in cash. Revenue's been cut in half. You get called in. There's a PE group and a group of investors who are saying, "Hey, we're not going to keep funding losses," basically, right?
Yep.
And what happened?
So so when we uncovered fraud, we said this company has to go through subchapter 5. We actually didn't initially intend to put it through subchapter 5. But when you combine management fraud with a bad balance sheet, then we had no choice. So it's a case where it was pushed into subchapter 5, and we basically managed it with the U.S. trustee's office kind of breathing down my neck. So I had emails constantly pop up from the Department of Justice, and I always got a little nervous when I saw them pop up because I thought I was in trouble. But no, that was never the case. So you have somebody watching you very, very closely. You have to report constantly back to them, which is why it's a tricky situation to be in. But I thought what together was a really good turnaround plan to that the courts did end up buying off on and putting us back into a payment plan, which would allow us to kind of get those sales back up to 25 million. That would flow much more cash back to the business than obviously an $11-12 million business burning $2.5 million in cash every year.
What were their debt service obligations on an annual basis kind of prior to this process, and then what did they get changed to?
Yeah, it's so a lot of it was a revolving loan with short terms. A lot of them were coming due, and then really what you're kind of hoping for from a subchapter 5 process is a 5-year spread of that of some type of reduced debt. So it's usually kind of 50 to 70% on the dollar for creditors plus over 5 years. So
Okay.
that gave me pause to say, okay, I'm going to sit there and do a cash flow model. I'm going to see what I can realistically pull off in a short period of time, because the courts are not going to sit and let you figure it out for 2 years. You have to do it pretty quickly. You have to say, I can enact improvement in cash flows in kind of 6 to 9 months. So again, you're getting a business pretty much at its liquidation value. Which is sounds appealing, but then you've got kind of a clock, counting down every single day, where you've got 6 to 9 months to make this work. And we knew from from our industry experience and from our history doing turnarounds that this could be done in 6 to 9 months and sold back off to another investor.
In this case, it didn't change hands right during the turnaround. The owners brought you in for a fee to come turn it around so that they could get to the point where they were going to exit.
That's right. Exactly.
Okay. Yep. Girdley, what kind of questions do you have? I'm peppering Michael over here.
Yeah. Well, we're doing a great job with this one. Do you want to move on to deal number 2? And then I definitely have more questions about how I definitely want to dig into how aspiring acquirers can leverage this segment of the market, because it's new to all of us. So,
yep. All right, Girdley, hit us with ad number 2, and then we'll go to deal number 2.
All right, man, I am so excited to be so commercial today. So today, our second advertiser is actually another podcast. So pretty cool. They've been with us for a couple episodes now, and it is acquiringminds.co. So pretty fun podcast. So Mills, I don't know if it's happened on some of the episodes that you've missed, but this was our first advertiser who wrote a script for me to read that actually allows me to make fun of myself.
Poke fun at us, yeah.
So perfectly good. So Acquiring Minds. So for those of you that are friends of Acquisitions Anonymous, we mostly hate the deals we look at. Acquiring Minds is for deals the other end of the spectrum. It's for deals that happen. So software businesses, and follows the journey of say like this guy Jason here, who bought a 45-year-old software business. Or different people who've bought businesses, what they learned, and bringing those lessons into the podcast. So Will and his team, I think, have put together a pretty good, fun podcast that has more positivity than ours. So definitely encourage you to take a look at it. It's at acquiringminds.co, and it is available wherever you get your podcast. Acquiring Minds is the name of that one. So on to the next one.
All right, Michael, give us deal number 2, and this is one that we're going to keep anonymized, as the name of the podcast implies.
Yeah, this one I actually like a lot more from like an investing perspective. This would be would probably be a little more interesting to your listeners, where I don't want to deal with court systems. Frankly, from my risk tolerance and how much pain I want to deal with, dealing with the court systems, and I learned firsthand with Peel, is not enjoyable. When you get to just simply straight up negotiate with creditors and kind of current ownership, that's when you start having a little bit more fun, kind of wheeling and dealing and trying to fix businesses. Mm-hmm. So this one was a 50-year-old Midwest big box retailer, about 10 locations, through the heartlands of the U.S., and had a string of profitable years, many profitable years, but kind of started taking it on the chin 2017, 2018, when Amazon and kind of the world started catching up with them. Being in smaller communities, being kind of having a loyal following kept them insulated for as long as you possibly could, being in retail. But finally, the Home Depots and the Amazons and the e-commerce of the world finally caught up to them, and you combine it with an ownership who were very knowledgeable in the industry, but not necessarily passionate on a day-to-day basis, because it was a long-term family business. They kind of made their money and kind of passed it off to dispassionate management to run the business. As soon as I walked into the stores, when we got brought on by the senior creditor, I saw empty shelves, I saw outdated inventory, and then when you started peeling back the onion, and we saw bad warehouse management practices, kind of broken communication chains between the store and head office, and I thought, this business is fixable. This is a very, very fixable business where we can do a lot more with it. For example, I saw inventory that, I kid you not, was sitting on the shelf when Bill Clinton was in office. So it had been sitting there for so long, that had, the boxes had literally discolored, sitting under fluorescent lights for 2 decades. So I'm like, there's a lot here that we can do with it. I don't have to put it through the bankruptcies. I've got a senior creditor who's willing to give us some time and take a pause on foreclosing on the assets, and I can really make this one work. So that's where we kind of sunk our teeth into it. We had recapitalized the balance sheet with us coming into the capital stack. And
so, Michael, real fast, digging into we really can make this work. What you led off with talking about the headwinds at this business, which sounded like kind of a generic home specialty retailer, kind of competing with the Home Depots and some of the folks like that. Like you got these huge headwinds of Amazon and Home Depot and Lowe's and whoever else they're competing with having massive economies of scale and efficiencies that come from that also. Besides the fact that this was just a horribly run business, what made you comfortable that the headwinds were something you could overcome?
One thing I really liked about them was I didn't have to do a lot of capex. I didn't have to completely redo the stores. I didn't have to redo the signage outside or the website or the distribution centers. Those were pretty good shape. What was really lacking was what people had the opportunity to buy. And when you started taking a look at the metrics of the company, and you got to take a look at what are the key metrics in that particular business. And with retail, it's how many people are walking in the door every day, and how much are they walking out of the door in terms of their average order value. And even though they had some of the worst inventory turnover I'd ever seen out of any retailer, they were turning it over kind of once per year. Which if you look at a Home Depot, they're turning it over 12 to 15 times a year. The foot traffic had really not dropped off all that much in a 10-year period. So 10 years ago versus today, even though sales had dropped off quite a bit, the number of people who are walking in the stores was still pretty steady. They were just buying a whole lot less, and that's because they didn't have the inventory. They just didn't have. They didn't.
Yeah, what's defensible about that business, right? As you think about it, is it because they own their locations? Is it because they're in markets too small to support some of those? Why even when you fix that thing, are you not scared of Home Depot?
A little bit of both those situations. But what really got my eye was they had categories that you would not find in a Home Depot. These guys were selling chicken roosts and things directly to rural communities that Home Depot would never touch. They had specific categories and products and relationships with suppliers that a Home Depot or an Amazon just couldn't compete on. And that's what I really liked. They just weren't updating those relationships. They weren't keeping them fresh. It was really a fault of the business, not of the supply chain. And that's why I thought we could turn this business around quite quickly. Because again, in any turnaround situation, you have a clock running against you. It's a case where you can buy a business for book value, to a discount on intrinsic value when it's an out of court situation. But then that's the upside. But the downside is, in order to keep the creditors at bay and keep them sweet, you have to do this fairly quickly. You have about 6 to 12 months when you're dealing with an out of court situation to show real progress.
So, Michael, quantify this one a little bit for us. What kind of was revenue did revenue fall? What did it fall to? And then what was happening from an earnings perspective in the business?
Yeah, it went from 40 to 30 million. And
over how long?
It was much more of a slower burn. Didn't have as much COVID impact as as our first case did. I would say that was probably over a 2 or 3 year period, kind of that burn down. But once you start getting into out of stock situations, it's you start getting into a death spiral where your sales drop, and then you run out of cash to be able to pay your vendors, and then your vendors start short shipping you, and then you don't have much inventory to sell, and then you can't pay your AP. Then they put you on credit hold.
Mm-hmm.
So what happens suddenly, gradually, all of a sudden happens suddenly, and that's what happened to these guys. So with some fresh capital and good, new inventory, I thought we could restock the shelves pretty quickly.
What was their earnings at 40 million, and what was it when you kind of got involved at 30 million in revenue?
In the good years, they're pumping out, 4 to 6 million in bottom line every year. We thought we could, even if we got it back to half that, we can. That'd be a huge swing in the enterprise value of the company.
Yeah. And then what was it when you got involved? What were the earnings when it got down to 30 million in revenue?
They were losing about 2 to 2.5 million a year in cash.
And in this case, one of the notes you gave us about it is, family run business. It sounds like no outside capital, working with one lender, in a smaller market, and the lender obviously is kind of tiptoeing around, hey, we have a lot of exposure here, but also we have relationship exposure. We don't want to be the bad guy who foreclosed on, this major employer, that type of situation. What were their debt service obligations like to this one lender? I'm thinking good times, right? If you're doing, $5-6 million in earnings, your debt service obligations are fine.
Yeah, they had term loans. So basically, what they had done several years prior is to upgrade the stores. They had borrowed against the real estate. So they'd taken out kind of longer term loans to do store upgrades, and then had a revolving line to pay for inventory. So where they got in trouble was as soon as revenue drops, they couldn't fulfill the term loans anymore, and that's what the bank stopped back and said, "Uh-oh, we're in a bit of trouble here." And if you're taking a look at it from a creditor perspective, they were a smaller bank. They were probably facing a lot of pressure from other COVID impacted businesses. Even though this was not a COVID impacted business, their other borrowers were, and they probably just needed an exit or some type of quick recapitalization of the balance sheet, which is what gets me excited. So when I see a bank that's desperate, when I see ownership with a lot of personal guarantees, which is what they had on a lot of the loans, and a business that I think could be turned around quickly without having to put a lot of additional capital into it above and beyond just the acquisition of it, then that's what gets me really excited.
Mm-hmm. So what were their debt service obligations? What was it on an annual basis? Just ballpark.
Yeah, it was about $1 million and a half a year.
Okay, and they're burning cash, so they can't meet those obligations. What's the nature of investing in a deal like this? You're getting involved, and the company probably needs an infusion of cash. They also need, like in your case, you could potentially facilitate an infusion of cash, but also, hey, we know how to speak to your creditors to give you some breathing room and maybe, renegotiate the terms of your loan. But like, what's the nature of investing in something like this? Like, this isn't on bizbuysell.com. It's probably not listed by a traditional investment bank, because those guys want companies that are going to sell relatively quickly and sell for high multiples because they have cash flow.
This is a case where you either know a turnaround specialist, a restructuring firm like ours, who can create that deal flow for you, or you have your own kind of built-in network of senior bankers, as special asset bankers, who will come in and say bring you onto deals when they're struggling with a file. frankly, they
So in this case, though, if you're investing in something like this, you're writing a check, right, to get some cash on the company's balance sheet, which also makes the lender feel a little bit better about renegotiating terms. Is that kind of how it works?
yeah, it's the bank having a conversation with the current ownership, saying, "You're in trouble. You're not fixing it. We can either do one of two things. We can either foreclose on the loan, or you find somebody to come in and help you." So they've basically
Mm-hmm.
done the work for you and put a gun to their head. And sometimes you get a real pushback. Sometimes you have a long-term legacy family business and they don't want to give up any equity. Sometimes they have no choice, or they're gonna basically lose the business. So I love it when
In this type of case,
this
does the family retain control?
they retain control in this case. Yes, we do not take more than 51%.
So minority investor comes in, helps shore up the balance sheet, and also say, hey, look, we're gonna roll up our sleeves and we're gonna help you get from point A to point B. Point A is where you are right now, losing money. You're in a tight spot with your lenders. Point B is we're cash flowing, your lenders are satisfied, and structurally the business has kind of changed and maybe modernized or whatever the playbook might be.
Yeah, that's correct. I want the bank to do the work for me and convince the owner, who may or may not be reluctant, that it's in your best interest to bring on capital help. Sometimes it's they don't go quite that far, and it's you're just helping them from an advisory standpoint. But a lot more times it's I need more capital into the business. Your balance sheet is not strong enough to support what's owed to me, and I'm gonna call the loan if I don't get that. And that's kind of that sweet spot of what I really like with turnarounds, where you're getting a business somewhere in between kind of that book value and a deep discount on intrinsic value. And then you're coming in with a skill set that they may not have, and capital that they may or may not have, and then kind of finding that delta by doing the turn.
What's the typical hold period for an investment like this, Michael? I mean, is it something where you're in this for 12 to 18 months and then the family's taking you out, or what's the typical duration?
Yeah. It's about a 1 to 2 years.
Okay.
We're here for for a good time, not for a long time. So if it's a really sweet business, which don't come along all that often, we'll stay longer. If they have some real growing market with a proprietary product that is that we can see a lot more runway on, we'll stick around longer. But oftentimes it's more just fixing fundamentals in the business, shoring up the balance sheet. We've done that. We've got the business back, and away it goes. We'll on to the next one.
When I think about the unit, or you go ahead,
yeah,
Michael.
what percentage of your business is actually, having some skin in the game by being on the cap table, bringing some of that capital, or having LPs come in with you, and then what percentage is just doing it as a service?
Pretty much every single business needs more capital. I would say about 25% of the time we'll join the stack, and 75% of the time we'll raise it either through more debt or an equity raise.
Got it. But some of that but yeah, so it sounds like 75% of the time you're just a fee-based service provider, and 25% of the time you show up on the cap table, put your own capital in, or bring
it's our own capital. We're not pulling in outside advisors. Oftentimes it's we're just not comfortable with the situation, or we don't like the situation, and it's better suited for somebody with a more of a longer term structure, timeline in mind, or maybe a different skill set, or a different risk tolerance. So 25% of the time we'll actually join the deal and benefit that way.
Yeah. And then if people want, it sounds like there's a benefit to turning yourself into a somewhat of a turnaround specialist. If you want to invest in them as well, there's synergy there for your business. And maybe you can argue with that premise, but my real question is, how do people actually get into the turnaround business? Like, what's the career path that kind of gets you there, and how does that work?
Yeah, a lot of people are either former business owners like myself, or they've come up through like a Deloitte or an Ernst & Young, who already have turnaround turnaround spaces within their firm. We've got a lot of ex-bankers, in this space, and a lot of reformed lawyers who want to move into this. So, a lot of my colleagues and myself, are former, who have done this in a whether we liked it or not, in a in our own business sense, and we want to join a bigger capital pool or get more of a deal flow. So we join or start our own firms.
Yeah, dig it. And then
Michael,
do you guys? I'm sorry, one more.
You go ahead, Gurley.
And so do you guys tend to specialize in stuff? It sounds like you're very much a CPG / retailer. Do other folks specialize in other categories, financial services firms or tech or that kind of thing?
Yeah, it's so myself as I'm very focused on CPG. Any type of consumer product. It doesn't have to be to the consumer. I do B2B as well. Retail. Our firm is pretty much industry agnostic, though. We'll do a whole bunch of different deals. We've done medical device companies, commercial printers, direct mailing companies, tech firms, like a whole bunch of different verticals we have. If my advice for for the listener here is probably stick to something you're familiar with, especially kind of for your first turnaround. If you have a lot of industry knowledge and can kind of pick up those signals like, hey, 70% marketing spend is too much for this for a particular firm at this stage of growth, and can pick up those KPIs like pretty quickly, I would say that would be the kind of the best way of getting into the turnaround space initially. There's also guys for hire. So if you want to get into the turnaround space but need somebody to hold your hand, there are turnaround firms out there and turnaround specialists to kind of help guide you along the way, and you can either compensate them by the hour, or bring them on for a commission or part of the capital stack.
And so let's say I'm Joe Schmo, right? I know how to go if I want to become a real estate broker, I know how to go get my first deal. Like, I just start networking everybody and call property owners. How does somebody that wants to say has found that Sherpa and wants to get into the turnaround space, like how are you guys finding and creating deal flow and building a brand for yourself? Is it starting cold calling bankers? Is it how does that all work?
Yeah, I would that would probably be your best space to say, hey, this is the industry I specialize in. This is how much capital I have to deploy. Keep your eye out for me when you have a deal come across your desk. I'm interested in taking a look at it. Again, you can also leverage somebody like myself who's already built that network with us in our firm. If you're saying, hey, I'm interested in a deal, but I just don't have the time, or I'm uncomfortable cold calling a bank, chat with us. I send deals to actually Twitter, some of my Twitter followers, pretty consistently. Actually, later today, I'm talking with a Twitter follower who approached me and said, hey, I'm interested in such and such industry. Do you have a deal in mind? And guess what? I have a deal like that, to have him look at like immediately.
Yeah,
because it's something we've invested in, but we're also like very keen on having that more longer term capital piece. We're kind of halfway through the turnaround, but I need to start finding the capital now to kind of pass it off, and I'm bringing him into it.
Super cool. I know some guys that did turnarounds in the amusement space. So like when there would be underperforming like amusement parks and stuff, they would go in and fix them. And after about 12 years, they decided the quality of life was so bad in their 40s. They were like, we're done. Like, we can't do this anymore because it was just going from one fire to the next that was never really caused by them. So, is this an industry that you see a lot of 60-year-olds running around, or is it a young man's game or a young woman's game?
Hopefully it's coming through the camera here that I am a younger guy. Still got the hairline going on here, but
because you tell me about your job and I'm not interested. I'm about 15 years older than you, I think, and I'm like, oh, that sounds awful.
It's not for the faint of heart. To be honest with you, it's not for the faint of heart. It's not putting money into Apple and hoping you get a 2x return or Bitcoin or whatever. It's a challenge. There's a lot of pitfalls you have to go through, and a lot of stick handling. I had to. I've had days where I've had to fire 10 people in a day. There's other days where I've had to, deal with screaming bankers or, vendors who are not getting paid. And so it's not for the faint of heart. There's definitely some significant upside that can be had with distressed turnarounds, but you have to have that mindset and the patience to be able to kind of see the process through.
Let's talk about that just really quick, Michael. So if you think about the universe of investable assets and the risk reward trade-off and expected rates of return. So, public market equities trade at, EV to EBITDA of, 20 times, right? And so you invert that and you say, okay, my expected return on this might be 5 to 6% a year annualized. Real estate might trade at a 6 or 7% cap rate or whatever it is. Lower middle market, businesses that sell in the SMB space might trade for anywhere from 3 to 5 times, cash flow. So unlevered, you can kind of do the math on what the yield is there. What's the expected return profile of something like this, given that it is highly illiquid, right? And a lot of it is contingent on completely changing course in the business. It seems like with all that risk priced in, the expected rates of return, you have to be compensated for that.
Yeah, if I'm not getting a 5 to 10x on these investments, then I'm not interested. It's not worth the headaches and the pains that you're going to be dealing with going through a turnaround. So if I can't 5 to 10x my capital, then I'm moving on to the next deal, which is often what we see, and one of the main reasons why we just do it as a capital, as an advisory and not with capital, because we don't feel like we can get that 5 to 10x.
Interesting, man. This is so cool. It's really, really fascinating. Girdley, any other questions you have before we wrap up?
No, thank you so much, Michael. This is super cool.
And big thanks to our sponsors again. Give you one more shout out to say thanks.
Acquiringminds.co, so podcast about people who've done successful small business acquisitions, and then the tinyacquisitions.com, the website where you can go to buy small side projects for less than $10,000 and make them your own business.
Big thank you to our sponsors. Michael Yarmo, as we kind of fade out, how can our listeners and the folks who tune into this podcast on YouTube, how can they support you? How can they keep in touch with you and follow what you're doing?
You can follow me on Twitter at Michael Yarmo. I've also got a Substack where I'm posting stuff on the distress industry all the time. Been a little bit slower lately with the newborn kind of taking up a lot of my time, but I posted quite a lot of content over there. And also, I do offer a link to thedailydac.com, which is a deal flow site for more distressed.
I think Michael's AirPods died.
I have checked out Michael's. Oh, maybe
we lost Michael. He's got a Substack too and a good Twitter.
I have really enjoyed his Substack. It's I really enjoy his newsletter writing, and it always is kind of cool to see the other side of the coin, so to speak, with distressed investing. Well, we'll get Michael Yarmo back here at some point, but we can wrap up for now. And thanks everybody. We'll see you again next week.
Awesome. Go Chili's. Happy Halloween.